In today's video, we are diving into exchange-traded funds, how they work, the advantages and disadvantages, how to choose the right ETF, some investment strategies, and at the end, I'm going to share some valuable resources that you can use to do your own research. ETFs have become increasingly popular among investors in recent years. Do a search on ETFs and you'll immediately be overcome with so many different resources that it can be a little bit overwhelming. So today we're going to work to simplify that process so that after watching this video, you're going to feel more knowledgeable and maybe even motivated to make an ETF selection for your portfolio. But perhaps we should start with a simple definition of ETFs. Exchange-traded funds are a type of investment that is traded on a stock exchange, and because of their accessibility, ETFs provide investors with access to a diversified portfolio of assets. And because each ETF is a basket of assets, it can hold stocks, bonds, or commodities. There are ETFs to address specific market sectors, characteristics like dividend-paying stocks, or geography. Perhaps you're looking for regional or international exposure. There's also ETFs that invest solely in precious metals, real estate, or if you're interested in owning all the dividend aristocrats, you can invest in one ETF and own a part of all of them. So what's the draw? Why are ETFs important in the current investing climate? Well, there's several factors, including their ease of use, low cost, and flexibility. And a big piece of the draw is definitely the diversification. Where else can you gain quick access to a diversified portfolio of assets with just one investment? The diversification helps to reduce overall portfolio risk and volatility. For example, if you invest in a single stock and the company fails, well, now what? You've lost your investment? If instead you invest in an ETF and one of the companies within the ETF fails, it'll just be replaced with another company based on the structure of that particular ETF. To understand one such ETF structure, we can look at SCHD, or the Schwab U.S. Dividend Equity ETF. This ETF goes through an annual reconstitution where each of the companies held must maintain certain characteristics to continue to be part of the ETF. This reconstitution happens annually in March, and if you'd like more information, I'll link to a recent video so you can learn more. But the bottom line is that the diversification of an ETF allows you to put your helmet on and reduce your overall risk. Another draw for investors are the lower fees. ETFs typically have lower fees than actively managed mutual funds, making them an attractive option if you're looking to invest without a huge cost. And this brings me to the need to share the differences between mutual funds and ETFs. Let's run it down and look at 5 key areas of comparison. In terms of the overall management, mutual funds have a professional fund manager who makes decisions about which securities to buy and sell within the fund's portfolio. So the fund manager conducts all the research and does their analysis to identify what they believe will perform well. And they use this information to make investment decisions on behalf of the fund's shareholders. But this comes at a cost to the investor, as we need to pay the fund manager to make all those decisions about which companies will remain in the mutual fund and which will not. The cost, or management fee, is typically a percentage of the fund's asset under management, or AUM, and can range anywhere from 0.5% to 2%, and some are even higher. And those higher costs may reduce an investor's returns, which is why many investors have moved to the passively managed ETF style of investing, as the costs can be significantly less to investors. The goal of a mutual fund is to outperform a specific benchmark, like the S&P 500. And they're only traded at the end of the day and are only required to disclose their holdings on a quarterly basis as mandated by the Securities and Exchange Commission, or the SEC. ETFs, however, are passively managed and follow specific market sectors, and as such, have lower costs associated with their management. The goal of the ETF is to match that specific index or market that they're following. So in the example earlier where we discussed SCHD, it's following the Dow Jones U.S. Dividend 100 index, so therefore has a lower expense ratio. The other benefit to ETFs is that they're available for trading whenever the market is open and disclose the holdings contained in the ETF every day. At a very high level, there's 2 types of ETFs: index ETFs like SCHD and actively managed ETFs that are very similar to a mutual fund, where they have a fund manager who's going to attempt to beat the performance of a benchmark index. There are, however, a few disadvantages of investing in ETFs: the costs, the concentration risk, security selection risk, and lack of customization. If you were to purchase a single stock, there's no cost associated with it if you're making your trades on a brokerage. There are lots of brokerage options like Fidelity, Vanguard, Robinhood, and M1 Finance, to name a few. But if you purchase shares of an ETF, you will need to pay an expense ratio. In most instances, expense ratios are calculated and charged annually and will be deducted out of the total value of your investment right from your account. Let's compare two popular ETFs that have vastly different expense ratios. And we're going to assume an initial investment of $10,000, then plan an annual contribution of $6,500. Maybe we're under 50 years old and we're contributing to our Roth IRA. If we assume a 30-year time horizon and a 6% rate of return, the only thing that we're going to change in this scenario is the expense ratio. Now let's take a look and see what we get. For starters, the gross value in either one of these portfolios is $602,145. If we assume an expense ratio of 0.06% shown on the left, you'll see that our expenses make up 1.2% of the total net value at the end of 30 years. If we look at the one on the right, this ETF has an expense ratio of 0.35%. If we break it down further, you can see that the 0.06% expense ratio ends up costing you just under $7,000 by the end of 30 years, and your net value is reduced to $595,154. With the ETF on the right, the total cost is $39,531 over the course of 30 years, leaving you with a net value of $562,614. I share this with you so that as you're making decisions for your own investment portfolio, that you're mindful of the expense ratio and the significant impact it may have over time. Another potential downside to ETF investing is concentration risk. This occurs when you invest in an ETF that may follow a particular asset class or sector. So for example, if you have a large portion of your investment in real estate-focused ETFs, and the real estate sector is on a downturn, this could have an adverse effect on your overall portfolio value. Looking here on the FinViz website in the Groups tab, you can see that in the last year, the relative performance of real estate is down 24.72%. Some ETFs may include companies that don't particularly align with your values or beliefs. For example, an investor who's focused on environmental, social, and governance (ESG) issues may find that certain ETFs include companies that do not meet their ESG criteria. And lastly, we have the lack of customization. Some investors love the thrill of the hunt when selecting specific individual stocks to add to their portfolios. With an ETF, the selection is done for you. You get what you get, and you can't get upset. When selecting an ETF for your portfolio, consider these three things. Either know or create an investment strategy before you start hitting the buy button, evaluate ETF's performances, make sure that you're investing in a solid option, and then select an ETF that you think best represents your investment needs and strategy. I recently did a video on investing strategy that I'll link in the comments below if you need a starting point. But overall, it involves identifying your investment goals, your time horizon, and your risk tolerance. For example, if you have a long-term investment horizon and are looking for exposure to a specific market segment, such as technology or healthcare, you may consider an ETF that tracks that segment. Next, you need to evaluate an ETF's performance, which involves analyzing key performance metrics such as total return, volatility, and expense ratios, as we just talked about earlier. So where do you begin your search? Well, there's a lot of great resources that I'm going to share with you right now. For starters, we can pop on over to etfdatabase.com, where they have this fantastic directory from A to Z, and you can sort by asset class, sector, industry, region, country, bond duration, commodity exposure, natural resources, currency. I think you guys get the drift of what I'm talking about. Now, because I'm a dividend investor, I like to sort by the dividend tab. And again, those same different options to sort this information are available to you under the dividends tab. Another great resource is ETF.com. And if you select the tool option, you can see here there's an option to compare ETFs. This will allow you to select specific ETFs to compare, or you can even use some popular comparison that folks have already done in the past. And it's here that you can review a general overview, performance over time, costs, as well as the top 10 holdings in each of the ETFs. Another favorite of mine is the ETF Research Center, or etfrc.com. And here you have even more tools at your fingertips. A favorite of mine is the Fund Overlap tool, where you're very quickly able to discern the holdings that two ETFs may have in common with one another. Let's take a look at SCHD and DGRO, for example. You can see here that SCHD actually has 47 holdings that are also contained within DGRO. However, DGRO, given that it's a much larger ETF, only 10% of its holdings are held also within SCHD. As you're working through the research to select the right ETFs for your portfolio, just a few things to consider. 1. Diversification. It's important to consider the diversification benefits of each ETF, as well as how it fits into your overall investment portfolio. For example, if you already have exposure to large cap stocks, maybe you want to consider an ETF that provides exposure to small cap or international stocks. Expense ratios are also an important factor, as we saw earlier. Those lower expense ratios generally result in higher returns over the long term, so it's important to choose ETFs with expense ratios that are reasonable and competitive. ETFs with higher trading volume tend to be more liquid, which can make it easier to buy and sell shares at the desired price. However, higher trading volume doesn't necessarily guarantee better performance. It's important to understand the index methodology used by each ETF, as this can impact its performance and risk characteristics. So for example, SCHD, the Schwab U.S. Dividend Equity ETF, follows the Dow Jones U.S. Dividend 100 Index and goes through an annual reconstitution to determine which companies will remain a part of the ETF. I recently did a video outlining the most recent changes to SCHD, and you can watch those after you finish this video. I'll link it in the comments below. So assuming you've made it this far, you're likely seriously considering adding an ETF to your portfolio, or perhaps it will be the only holding you keep. So let's talk about some trading strategies here. One of the most popular strategies is to buy and hold. Pretty self-explanatory. Buy them and hold on to them, especially if you're a dividend investor and compounding over time. If you hold on to those investments, your snowball is only going to get bigger and bigger. Check out that recent video that I did explaining the dividend snowball. It will blow your mind and make you wish you started investing so much sooner. You can also use dollar cost averaging to get into a position with an ETF, and this is where you're going to buy a fixed amount of money of ETFs at regular intervals, such as weekly or monthly. Because the market fluctuates, there's going to be days when the share price is high and days when the share price is low. So over time, you are dollar cost averaging into a position which can help reduce the impact of market volatility. I personally buy 1 or 2 shares of SCHD every single Monday. Now, it's your turn to educate me. What are your favorite ETFs and why? Please leave me a comment below and share in the excitement of the dividend snowball by watching this video next.